There is a number, a single number that appears on the financial statements of every publicly traded company in the world. And for the vast majority of investors, for the millions of people who dedicate their savings and their hopes for financial freedom to the stock market, this number is the headline. It's the metric that sends stocks soaring or sends them crashing down. It's the number that analysts obsess over, that news anchors breathlessly report every 3 months. It's called earnings per share, net income, the bottom line. And it is, for the most part, a complete and utter fantasy, a fiction, an opinion masquerading as a fact. This single, seductive number is the source of more capital destruction, more portfolio heartbreak, and more catastrophic investment mistakes than any other metric in the modern financial world. Because the secret, the one that separates the legends of investing from the legions of the frustrated, is that a company can report soaring, record-breaking profits and be just weeks away from bankruptcy. It can look like a world-beating success on paper while it is, in reality, a burning building, hemorrhaging the one thing that actually keeps a business alive. That one thing is cash. Warren Buffett, the man who built a $250 billion empire from a dying textile mill, understood this truth in his bones. He realized early in his career that the entire game played by Wall Street, the obsession with quarterly earnings, was a grand illusion. It was a stage play, artfully constructed by accountants and executives, that often bore little resemblance to the economic reality of the business itself. While everyone else was reading the script, the income statement, Buffett was backstage, counting the actual cash in the till. He knew that you can't pay your employees with earnings. You can't build a new factory with net income. You can't buy back your own stock or pay a dividend to your shareholders with a number on a spreadsheet. You can only do these things with cold, hard cash. This is not a minor distinction. It is the fundamental dividing line between a business owner and a stock speculator. It is the difference between investing in a company and betting on a ticker symbol. And mastering this distinction is the single most powerful transformation you can make in your journey toward true financial literacy and long-term portfolio growth. You are about to learn how to discard the fantasy of reported profits and embrace the brutal, unvarnished reality of cash flow. You will learn to read the one number that cannot be faked, the one number that reveals a company's true health, its true ability to generate wealth for its owners. This is the foundation of intelligent investing. It is the key to unlocking a CEO mindset, to moving beyond the noise of the market and analyzing a business with the cold, clear eyes of a proprietor. It is the first and most important step toward beating the market not through luck, but through superior understanding. Our journey begins by dismantling the very foundation of modern financial analysis, by exposing the illusion of earnings. In 1972, a man named Charlie Munger, who would later become Buffett's indispensable partner, brought him an idea. It was a little-known chocolate company based in California called See's Candies. On the surface, it seemed like a decent but unspectacular business. The company was being offered for sale for $30 million. But Buffett, after a quick look at the numbers, countered with an offer of $25 million. His offer was based on the company's reported book value and its net income, the traditional metrics of the day. The sellers, the See family, were insulted. They stood firm at $30 million. Buffett, a man known for his pathological aversion to overpaying, was ready to walk away. By the conventional standards he had used for years, the price was just too high. The reported earnings simply didn't justify the valuation. But Charlie Munger was persistent. He pushed Buffett to look deeper, to look past the numbers on the income statement, and understand the real economic engine of the business. See's Candies, he argued, was not just a collection of assets and a stream of accounting profits. It was a cash machine. Think about the business model. Customers walked in, paid cash for a box of chocolates, and walked out. The company got the cash immediately, up front, but it didn't have to pay its suppliers for the sugar, the chocolate, the boxes for 30 or 60 days. This created what is known as float, cash that the company could hold and use before it had to pay its own bills. Furthermore, the business required very little capital to grow. To open a new store, they didn't need to build a massive billion-dollar factory. They needed a lease, some display cases, and an inventory of chocolates. The capital investment was minuscule compared to the cash the store would generate. The company's reported earnings were being artificially depressed by accounting conventions like depreciation of old equipment and storefronts, things that were on the books but didn't represent a real cash cost in the present. Buffett, prodded by Munger, began to see the light. He stopped looking at See's Candies as an accountant would and started looking at it as a proprietor, as an owner. He asked himself, if I owned this entire business, how much cash could I take out of it at the end of the year, without harming its competitive position or its future growth? That question changed everything. The reported net income was about $2 million, but the cash flow, the actual money the business was generating for its owner, was significantly higher. He realized the brand was so powerful, so beloved by its customers, that it had pricing power. They could raise their prices a little bit each year to cover inflation and then some, and the customers would happily pay it. This pricing power, combined with the low capital requirements, meant that See's was a gusher of cash. It produced far more cash than it needed to maintain its operations. This excess cash could then be used for anything the owner wanted: to buy other businesses, to invest in stocks, or to simply be paid out as a dividend. He paid the $30 million. It was a price that, based on reported earnings, seemed foolish to his old self. But based on the reality of cash flow, it was a steal. In the years that followed, See's Candies would go on to generate over $2 billion in cash for Buffett's company, Berkshire Hathaway. Money that was then redeployed into other world-class businesses, fueling the growth of his empire. That single transaction, that paradigm shift from focusing on the accounting illusion of earnings to the economic reality of cash, was one of the most important turning points in his career. It was the moment he cemented the first pillar of his philosophy. Reported profits are an opinion, but cash is a fact. The reason this illusion of earnings is so powerful and so dangerous is rooted deep in our psychology. We are all susceptible to a cognitive trap known as the anchoring bias. This bias describes our tendency to rely too heavily on the first piece of information we receive when making a decision. In the world of investing, that first piece of information is almost always the headline earnings per share, or EPS. A company reports record profits, and that number becomes the anchor in our mind. We anchor on the idea that this is a successful company. Once that anchor is set, another bias kicks in, confirmation bias. We then subconsciously start seeking out information that confirms our initial belief and ignoring information that contradicts it. We read the CEO's optimistic letter to shareholders, we see the stock price going up, we notice other people buying it, and all of this confirms our initial anchor: this company is a winner. We conveniently ignore the dense, complicated cash flow statement tucked away in the back of the annual report because looking at it might challenge our comforting, simple narrative. The earnings number is easy to understand. It's a single, clean figure. The cash flow statement is messy. It has 3 different sections and a lot of adjustments. Our brains are lazy. They prefer the simple anchor to the complex reality. This is how millions of investors get trapped. They see a company like, for example, a fast-growing tech startup that reports a small but growing profit. The anchor is set: profitable tech company. They buy the stock, but they fail to see on the cash flow statement that the company is burning through hundreds of millions of dollars in cash every quarter, funding its operations by constantly selling new shares and diluting existing shareholders into oblivion. The reported profit was a work of accounting fiction, perhaps achieved by capitalizing expenses, counting them as an asset instead of a cost, or using other aggressive revenue recognition policies. The reality, the cash flow reality, was that the business was a capital incinerator. But by the time the average investor figures this out, the stock has collapsed, and their capital is gone. This is not a rare occurrence. It is the standard operating procedure for a huge swath of the market, and it's a trap that is set by our own psychology. So how do we break free from this trap? We need a practical, applicable mental model. Let's call it the accounting versus reality filter. This is a blueprint you can use every single time you look at a company's financial statements, a way to train your brain to question the fantasy and seek the fact. Step 1 is to open the income statement, look directly at the bottom line number, net income, and immediately say to yourself, this number is an opinion. Now my job is to find out how much of this opinion is based on reality. Step 2 is to scan up from that number and look for the biggest non-cash charges. The two most common culprits are depreciation and amortization. These are accounting expenses. The company isn't actually writing a check for depreciation. It's an accountant's estimate of how much an asset has declined in value over a period. A company can change its assumptions about the useful life of its assets to make depreciation smaller and, as if by magic, make its reported profits look bigger. You must learn to see this number not as a real cost, but as a clue. Add it back to net income in your head. This is the first step toward finding the cash. Step 3 is to look for other major non-cash items. A huge one in the modern economy is stock-based compensation. A company pays its employees with stock options instead of cash. On the income statement, this is recorded as an expense, reducing profits. But again, no cash is leaving the building. From a cash perspective, it's a non-event. However, it is a very real cost to you, the owner, because it dilutes your ownership stake. The key is to recognize it for what it is, an accounting entry, not a cash flow. Step 4 is to ask the critical question: where in this income statement could management be making aggressive assumptions? Revenue recognition is a big one. Did they book revenue for a sale before the cash was actually collected? Are their accounts receivable ballooning? This is a red flag that their reported sales aren't turning into actual money. By applying this simple 4-step filter, you begin to retrain your brain. You stop accepting the income statement at face value. You start treating it like a crime scene, looking for clues, questioning the official story, and trying to reconstruct what actually happened with the cash. This is the first and most critical skill in developing a true CEO mindset for your own portfolio. The vast majority of market participants, the 99%, follow a completely different path. They are the EPS chasers. Their entire strategy is built around the fantasy of earnings. They listen for the whispers of what the Wall Street consensus estimate for a company's earnings will be. When the company reports its quarterly numbers, their only question is, did they beat the estimate or did they miss? If the company reports earnings of $1 per share when the estimate was 99 cents, they see this as a massive victory. The stock pops, they feel like a genius, and they buy more. If the company reports 98 cents, they see it as a catastrophe. They panic and sell. Their entire emotional and financial state is tied to this tiny deviation in an accounting opinion. This mindset reached its most spectacular and destructive peak during the dot-com bubble of the late 1990s. Companies with no revenue, no profits, and no viable business model were coming to the market and being valued in the billions of dollars. How was this justified? Through a new, even more fantastical metric, pro forma earnings. These were earnings calculated by excluding all the bad stuff, like marketing costs, research and development, and employee salaries. It was a complete fiction, but it allowed these companies to tell a story of progress. The EPS chasers bought it hook, line, and sinker. They ignored the fact that these companies were burning through cash at an astonishing rate, staying alive only by selling more and more stock to a gullible public. They were anchored to the narrative of the new economy, and they confirmed this belief by watching the stock prices go up every day. The cash flow statements, for anyone who bothered to look, told a horror story of businesses that were fundamentally, catastrophically broken. When the bubble burst, fortunes were wiped out overnight. The EPS chasers who had felt like geniuses just months before were left holding worthless stock certificates. They had mistaken the script for the play. They had fallen in love with the illusion and paid the ultimate financial price. This is the path of the 99%, A constant cycle of chasing headlines, getting burned, and never quite understanding why, because they are fundamentally looking at the wrong number. The direct financial connection here is stark and undeniable. Let's make this tangible. Imagine two companies, Company A and Company B. Both operate in the same industry. Both report exactly $100 million in net income for the year. The EPS chaser looks at both and says, they are equally profitable. I'll buy whichever one has a lower stock price. But you, armed with the accounting versus reality filter, dig deeper. You look at their cash flow statements. You discover that Company A, after adding back depreciation and making adjustments for working capital, had to spend only $10 million on capital expenditures, the money needed to maintain and upgrade its factories and equipment. So, its free cash flow, the real cash available to the owners, was $90 million. A huge portion of its reported profit was real, spendable money. Now you look at Company B. It also had $100 million in net income, but you discover that it operates in a much more capital-intensive part of the industry. Its machinery is older and requires constant, expensive upgrades. Its capital expenditures for the year were a whopping $120 million. So, its free cash flow was its $100 million in net income, minus its $120 million in capital expenditures, resulting in negative $20 million. Despite reporting a massive profit, Company B actually burned through $20 million of cash just to stay in business. Company A can use its $90 million to pay dividends, buy back stock, or acquire competitors, all of which directly increase shareholder wealth and drive long-term portfolio growth. Company B, on the other hand, has to find $20 million just to plug the hole. It will have to take on more debt, which increases risk, or sell more shares, which dilutes your ownership. On the surface, on the income statement, these companies looked identical, but in economic reality, one is a wealth creation machine, and the other is a capital destruction machine. The ability to see this difference is not just an advantage, it is the entire game. It is the foundation upon which all sound business analysis and intelligent investing is built. Once we have successfully dismantled the illusion of earnings, we are left with a void. If net income is a fiction, where do we turn for the truth? The answer lies in the document that most investors ignore, the statement of cash flows. This is the second pillar of our philosophy, the sanctity of this often overlooked financial report. While the income statement is an opinion, the cash flow statement is a fact-based history. It is like a security camera monitoring a bank vault. It doesn't offer opinions on why money is moving. It simply tracks every single dollar that comes in and every single dollar that goes out. It tells the unvarnished chronological story of a company's relationship with cash over a period of time. There are no pro forma adjustments here. There are no accounting estimates for depreciation. It is simply cash in, cash out. As a result, it is infinitely harder for a management team to manipulate. A company can't fake the amount of cash in its bank account at the end of the year. Warren Buffett's investment in the Washington Post Company in the early 1970s is a masterclass in appreciating the sanctity of the cash flow statement. At the time, the Washington Post was a publicly traded company, but it was still controlled by the Graham family. On the surface, its financials looked mediocre. Its reported earnings were unimpressive, and its stock price languished. Wall Street analysts were not interested. They looked at the income statement and saw a boring, low-growth newspaper business. But Buffett saw something entirely different. He wasn't looking at the income statement, he was looking at the underlying cash-generating economics of the business. He recognized that a major city newspaper in that era was a natural monopoly. If you were a department store in Washington, D.C., and you wanted to advertise a sale, you had no choice but to advertise in the Post. This gave the company immense pricing power. They could raise their advertising rates year after year, and the cash would just roll in. Furthermore, the business required very little incremental capital investment. Once the printing presses were bought and paid for, they could last for decades. The cost of adding one more newspaper to the daily print run was trivial. So here was a business with a powerful competitive advantage, a moat that allowed it to raise prices consistently, and a business model that did not require it to plow all that money back into operations. The result was a gusher of free cash flow. The income statement was hiding this reality. It was weighed down by the heavy depreciation charges on the old printing presses, making reported profits look small. But Buffett, by focusing on the cash, could see the truth. He saw a magnificent business that the market was valuing as a mediocre one. He began buying shares aggressively, investing over $10 million, which at the time was a huge sum for him. That investment would go on to be one of the most successful of his entire career, multiplying in value over 100 times. The market was fooled by the accounting illusion. Buffett found the truth in the cash flow statement. He understood its sanctity as the ultimate record of a business's economic performance. The psychological principle that the cash flow statement helps us overcome is the powerful and pervasive narrative fallacy. Coined by Nassim Nicholas Taleb, the narrative fallacy describes our tendency to create and believe coherent stories to explain random facts and events. We are storytelling animals. We prefer a simple, compelling narrative over a complex, messy reality. In the world of investing, CEOs are master storytellers. They get on conference calls and paint a beautiful picture of future growth, of innovative new products, of synergies from a recent acquisition. They weave a compelling narrative designed to make us feel optimistic about the company's future. And we want to believe it. This narrative is often reflected in and supported by a rosy-looking income statement. The cash flow statement is the ultimate antidote to the narrative fallacy. It is a story too, but it's a story told in numbers, not words. It is the cold, hard, non-fiction account of what the company actually did with its money, not what the CEO says they are going to do. A CEO can talk all day about investing for the future, but the cash flow statement will tell you precisely how many millions of dollars were spent on new equipment versus how many were spent on a lavish new corporate headquarters. A CEO can talk about strengthening the balance sheet, but the cash flow statement will show you whether the company was actually paying down its debt or secretly taking on more. It cuts through the narrative and exposes the reality. It prevents us from falling in love with a good story and forces us to confront the financial facts. The discipline of starting your analysis with the cash flow statement is a powerful way to inoculate yourself against the seductive but often misleading narratives spun by corporate management. To truly harness the power of this document, you need a mental model for reading it. Let's call it the 3-act play framework. The cash flow statement is beautifully structured into 3 distinct sections, or acts, that tell a complete story. Act 1 is cash flow from operations, CFO. This is the protagonist of our story. This section answers the most important question: is the company's core business actually generating cash? It starts with net income, and then makes all the adjustments we discussed earlier, adding back depreciation, accounting for changes in working capital, and so on. A healthy, growing company will have a consistently large and positive number in this section. If cash flow from operations is negative, it means the fundamental business is a cash drain. This is the biggest red flag a business can have. Act 2 is cash flow from investing, CFI. This section tells us what the company is doing with the money it generates. Typically, this number will be negative, and that's usually a good thing. A negative number here means the company is investing in its future, buying new machinery, building new factories, or acquiring other businesses. These are capital expenditures. What you want to see is a rational amount of investment that is likely to generate a good return in the future. A big red flag in this section would be a large times positive number, which could mean the company is so desperate for cash that it's selling off its assets, its factories, and equipment just to survive. Act 3 is cash flow from financing, CFF. This is the final act, where we see how the company interacts with its owners, shareholders, and its lenders, bondholders. If the company is generating more cash than it needs for operations and investing, it might use that excess cash to pay down debt, buy back its own stock, or pay dividends. These would all show up as negative numbers, cash outflows in this section, and they are generally signs of a healthy, shareholder-friendly company. Conversely, if a company isn't generating enough cash from its operations, it will have to raise money here. You would see positive numbers from issuing new debt or selling more stock. A company that is constantly raising cash in the financing section is often a sign of a weak business that cannot fund itself. By analyzing this statement as a three-act play, you see the entire story. A great company is one with a strong and growing CFO, Act 1, which funds intelligent investments in CFI, Act 2, and still has enough left over to reward shareholders in CFF, Act 3. A struggling company might have a negative CFO, forcing it to sell assets in CFI and take on debt in CFF just to keep the lights on. This framework transforms the cash flow statement from a confusing wall of numbers into a clear, compelling narrative of corporate health or sickness. The 99%, the antithesis of this approach, is the income statement-only investor. This individual lives and dies by two metrics: revenue growth and net income. They see revenues going up, and they get excited. They see net income turning positive, and they declare victory. They never make it to the third page of the financial report where the cash flow statement lives. They are therefore blind to the most critical information about the business. They might buy a retailer that is reporting fantastic revenue growth, not realizing that this growth is being driven by stuffing its stores with inventory that isn't selling. This would show up as a huge negative drain on cash in the, quote, changes in working capital line of the cash flow statement, but the income statement-only investor would be completely oblivious. They might buy a software company that is touting its profitability, without realizing that the company is spending a fortune on capitalized software development and investing cash outflow that doesn't hit the income statement immediately. The company looks profitable but is actually burning through cash. The income statement-only investor is flying blind. They are like a doctor trying to diagnose a patient by only looking at their photo. They are missing all the vital signs, the heartbeat, the blood pressure, the respiration, that are revealed in the cash flow statement. This is why so many people are perpetually surprised when a company that looked successful suddenly announces it needs to raise more money or is at risk of bankruptcy. The signs were there all along, just not in the one place they were trained to look. This lack of financial literacy is the primary reason why their portfolio growth stagnates and they never achieve true wealth management success. The direct financial connection of this pillar cannot be overstated. The interplay between the three sections of the cash flow statement is the literal engine of shareholder value creation or destruction. Think of it like a household budget. Cash flow from operations is your salary. Cash flow from investing is your spending on things that can improve your future earning power, like education or business equipment. Cash flow from financing is how you interact with your bank, paying down your mortgage or taking out a new loan. A financially healthy person has a salary that is larger than their living expenses. This allows them to invest for the future and pay down their debts. A financially sick person has expenses that exceed their salary, forcing them to sell their possessions and take on more and more credit card debt just to get by. It's exactly the same for a business. A company with strong, positive cash flow from operations can fund its own growth initiatives, the best kind of financing. It can build a new factory or launch a new product line using its own money. This is what shows up in the cash flow from investing section. If it's still generating more cash than it can intelligently reinvest, it can then return that capital to its owners. It can buy back shares, which increases your proportional ownership of the business and boosts earnings per share in a legitimate, non-accounting trick way. Or it can pay a dividend, which is a direct cash return on your investment. This is how long-term capital gains are generated. This is the virtuous cycle of a cash-generating machine. On the flip side, a company with negative cash flow from operations is in a vicious cycle. It must turn to the financing markets, constantly issuing new shares that dilute your ownership, and taking on more debt that adds risk and interest expense, crippling its future. The story of this cycle, virtuous or vicious, is told nowhere else but on the statement of cash flows. It is the single most important document for any serious entrepreneur, CEO, or intelligent investor. Having established that reported earnings are an illusion and that the cash flow statement is our source of truth, we can now move to the third, more advanced pillar, defining and calculating owner earnings. This is the specific metric that Warren Buffett himself developed to cut through all the noise and determine the true cash-generating power of a business. It's a refinement of the concept of free cash flow, viewed through the specific lens of a private proprietor. Buffett first laid out this concept in his 1986 letter to Berkshire Hathaway shareholders. He wrote, "If we were to buy a private business, our calculation of its earnings would be the amount of cash it would generate for us after we had paid for all the expenses and made sure its competitive position was maintained." This is the essence of the CEO mindset. You're not buying a stock, you're buying a business, and you want to know how much cash you can put in your pocket at the end of the year. The anecdote that best illustrates the evolution of this thinking is Buffett's purchase of the Buffalo Evening News. In 1977, Berkshire Hathaway bought the newspaper for about $32 million. Immediately after the purchase, a competing afternoon paper announced it would launch a new Sunday edition to compete directly with the Buffalo News's highly profitable Sunday paper. Buffett was faced with a critical decision. To compete, he would have to launch his own Sunday edition, a move that would require significant upfront investment and would guarantee years of heavy losses as the two papers fought a war of attrition. From a conventional accounting standpoint, this was a terrible move. It would crush the newspaper's reported earnings for the foreseeable future. Many corporate managers, obsessed with showing smooth, predictable quarterly profits, would have shied away from such a battle. But Buffett wasn't thinking about quarterly earnings. He was thinking about long-term owner earnings. He calculated the immense cash flow the Sunday edition would generate for decades to come if they won the competitive battle and became the sole survivor. He understood that the city of Buffalo could not economically support two Sunday newspapers. One would eventually have to fold. He viewed the upfront losses not as a hit to profitability, but as a capital expenditure, an investment required to secure a very valuable economic asset, the monopoly on the Sunday newspaper market in Buffalo. This is a crucial distinction that the concept of owner earnings makes clear. The difference between maintenance capital expenditures and growth capital expenditures. Maintenance capex is the money you have to spend just to keep the business running as is, to replace old trucks or patch the factory roof. Growth capex is the money you spend to expand, to enter new markets, or to vanquish a competitor. Buffett was willing to spend heavily on growth capex even if it meant short-term pain because he had his eye on the long-term prize, a massive stream of owner earnings. They fought the war, the competitor eventually folded, and the Buffalo News became a cash-generating machine for Berkshire, just as he had calculated. The psychological principle at play here is the dual-headed beast of the endowment effect and mental accounting. The endowment effect is our tendency to overvalue something simply because we own it. Once an investor buys a stock, they often become emotionally attached. It's their stock. This makes it difficult to assess its performance objectively. Mental accounting is our tendency to separate our money into different mental buckets. An investor might have a bucket for safe investments and another for speculative ones, and they apply different rules to each. Buffett's concept of owner earnings is a powerful tool to short-circuit both of these biases. It forces you to adopt a single, ruthless, and consistent perspective, that of a 100% owner of the entire business. When you calculate owner earnings, you are forced to ask, if I owned this whole company, would I be satisfied with the cash it's giving me relative to the price I paid? This question breaks the emotional endowment. You are no longer a passive owner of a stock. You are an active, prospective buyer of the business, constantly reevaluating the deal. It also shatters mental accounting. There is only one bucket, the business bucket. And the only question that matters is whether that business is generating a satisfactory cash return on your capital. This forces a level of rational, unemotional business analysis that is impossible when you're just watching a ticker symbol wiggle up and down. It transforms you from a stock market participant into a business analyst. So how do we actually calculate this metric? Let's create the blueprint, the owner earnings calculation mental model. It's a bit more nuanced than simple free cash flow, but this nuance is where the value lies. Step 1. Start with a company's reported net income. This is our baseline, the opinion that we are going to adjust back to reality. Step 2. Add back all non-cash charges. As we've discussed, this primarily means depreciation, amortization, and other similar items. We are adding back these accounting fictions to get closer to the cash reality. Step 3. This is the most important and the most difficult step. You must subtract the average annual amount of asterisk maintenance time capital expenditures. This is the amount of money the company needs to spend each year just to maintain its current level of operations and its long-term competitive position. It's the cost of replacing worn-out equipment and keeping the facilities up to date. This number is not explicitly stated in financial reports, so it requires some detective work. A good rule of thumb for a stable manufacturing company, for example, is that maintenance capex is often roughly equal to the annual depreciation charge. For other businesses, you might need to look at a decade of capital spending to get a feel for the baseline level of investment required. The key is to separate this necessary spending from the discretionary spending on new growth projects. Step 4. Make any necessary adjustments for changes in working capital. If a company's accounts receivable or inventory are growing much faster than its sales, it's a sign that cash is being tied up in the business and is not available to the owner. This would be a subtraction from owner earnings. Conversely, a business like See's Candies, with its negative working capital, would get a positive adjustment here. The final number you are left with after these 4 steps is Buffett's owner earnings. It is the best possible estimate of the true, sustainable, distributable cash that the business generates for the people who own it. This is the number you should be using to value the business, not the Fantasyland figure of net income. The antithesis to this rigorous, business-focused approach is the price-to-earnings PE ratio worshiper. This is probably the most common type of investor in the market. They have learned a simple rule: buy stocks with a low PE ratio. The PE ratio is calculated by dividing the stock price by the annual earnings per share. A low number, they believe, signifies a cheap stock. This is a dangerously simplistic and often misleading metric. The PE ratio worshiper is making the fundamental error of taking the earnings, at face value. They are anchoring on a potentially fictional number. They might see 2 companies, both trading at a PE ratio of 10, which seems cheap compared to the market average of 20. They conclude both are equally good investments. But what they miss is the underlying economic reality revealed by the owner earnings calculation. One of those companies might be a capital-light software business, where nearly all of the reported earnings convert into owner earnings. The other might be an airline, a notoriously capital-intensive business. The airline may report positive earnings, but it has to spend billions of dollars every year on new airplanes just to stay competitive. Its maintenance capital expenditures are enormous. As a result, its owner earnings might be 0 or even negative. The PE ratio of 10 was a mirage. The business wasn't cheap. It was a value trap. A business that consumes more cash than it generates. The PE worshiper is seduced by the apparent simplicity of the ratio and fails to do the necessary work of digging into the cash flow dynamics. This is the path to a portfolio filled with companies that are perpetually cheap for a very good reason. They are fundamentally poor businesses. The direct financial connection here is the ultimate determinant of long-term investment returns. The value of any financial asset, a stock, a bond, a piece of real estate, is the present value of all the cash it will generate for its owner over its lifetime. That's it. That's the definition of value. By focusing on owner earnings, you are focusing on the very thing that gives a business its value. By focusing on reported earnings, you are focusing on an accounting construct that can be wildly disconnected from that value. Let's return to our example of Company A, the software company, and Company B, the heavy industry company. Both have the same net income. Let's say both have a market capitalization of $1 billion, giving them the same P/E ratio. But Company A generates $90 million in owner earnings, while Company B generates only $5 million in owner earnings due to its massive maintenance CapEx needs. As an owner, you are getting a 9% cash yield on your investment in Company A. 90 million divided by 1 billion. You are getting a paltry 0.5% cash yield on your investment in Company B. Which business would you rather own? It's not even a close call. The ability of Company A to gush cash gives it a massive financial advantage. It can use that cash to develop new products, acquire other companies, or buy back its stock at a rapid clip, all of which will compound your wealth over time. Company B is stuck on a treadmill, spending almost all of its cash just to stay in the same place. Over a decade, this difference in cash-generating ability will lead to a chasm in the performance of the two stocks. This is the tangible, massive financial advantage that comes from ignoring the P/E ratio and focusing on the price-to-owner earnings ratio. It is the core principle behind value investing and the key to building lasting portfolio growth. With the ability to calculate the true cash earnings of a business, we can now ascend to the fourth pillar, using cash flow as a moat detector. A moat, a term popularized by Buffett, is a durable competitive advantage that protects a business from competitors, much like a moat protects a castle. It is what allows a company to earn high returns on its capital for a very long period of time. Moats can come in many forms: a powerful brand, a patent, a network effect, or a low-cost production advantage. But regardless of the source, the single clearest, most undeniable evidence of a great moat is a long history of strong, consistent, and growing free cash flow. A business that is constantly under assault from competitors cannot produce a stable stream of cash. It has to spend all its money on price wars, on marketing battles, on matching the innovations of its rivals. Only a business protected by a deep, wide moat can effortlessly generate more cash than it consumes year after year. One of the most dramatic examples of Buffett using cash flow to identify a moat under duress is the story of American Express and the salad oil scandal of 1963. A New Jersey company that traded in salad oil futures had perpetrated a massive fraud, using a warehouse full of fake salad oil as collateral for huge loans from dozens of banks, including a subsidiary of American Express. When the fraud was discovered, the salad oil company went bankrupt, and it looked like American Express was on the hook for massive losses. The market panicked. Wall Street assumed the company was ruined, that its reputation was shattered, and that the losses would be catastrophic. The stock price was cut in half in a matter of months. It was a moment of peak fear and uncertainty. The narrative was overwhelmingly negative. Buffett, however, did what he always does. He ignored the narrative and dug into the facts. He didn't just look at the balance sheet. He went out and conducted his own scuttlebutt research. He visited restaurants and travel agencies. He talked to merchants. He wanted to understand if the scandal had actually damaged the core business. What he found was that people were still using their American Express cards. Travelers were still buying American Express travelers' checks. The scandal, while a major headline, had not dented the fundamental trust that consumers had in the brand. The moat, the powerful brand and the trust it engendered, was fully intact. He then turned to the financials. He analyzed the underlying cash flow being generated by the credit card and travelers' check businesses. He saw that these operations were powerful, cash-gushing machines that were completely unharmed by the losses in the salad oil division. The cash flow was the proof. It was the signal that the moat was still wide and deep. While the market was panicking about the temporary earnings hit from the scandal, Buffett was focused on the enduring, cash-generating power of the core franchise. He saw that the market was offering him the chance to buy a phenomenal business for a fraction of its true worth. He invested 40% of his partnership's capital into American Express stock. The market eventually realized its mistake. The stock soared, and the investment became a legendary success, cementing Buffett's reputation as a brilliant contrarian investor. The cash flow was his anchor in a sea of panic. It was the objective evidence that revealed the strength of the company's competitive advantage when the emotional story was one of doom. This story highlights the psychological biases that a focus on cash flow helps to defeat: herd mentality and the fear of missing out, FOMO. Humans are social creatures. We are wired to follow the crowd. When a stock is soaring and everyone is talking about it, the pressure to buy is immense. This is FOMO. We're afraid of being the only one left behind. Conversely, when a stock is crashing and the headlines are terrifying, the instinct to sell with the herd is overwhelming. We sell not because our analysis has changed, but because we are scared. This herd behavior is driven by emotion and narrative, not by rational analysis. A rigorous focus on a company's historical cash flow provides the perfect emotional anchor to resist this pull. When a hot story stock is rocketing upwards, you can pull up its cash flow statement and ask the cold, hard question: is this business actually generating any cash? More often than not, with these types of stocks, the answer is a resounding no. They are burning cash, funded by the very hype that is driving the stock price up. This analysis allows you to calmly step aside and avoid the eventual crash. On the other side, when a great company's stock is plummeting due to bad news, like with American Express, you can analyze its long-term cash flow history. You can ask, has this event fundamentally and permanently impaired the long-term cash-generating ability of this business? If the answer is no, you can step in and buy with confidence, precisely when the herd is selling in a panic. This discipline, this ability to separate the business from the stock price, is the essence of the CEO mindset. You are not a sheep in the herd. You are a shepherd, making decisions based on the fundamental health of your flock, not its panicked movements. To operationalize this, we can use a mental model called the cash flow moat audit. This is a simple checklist to run through when you're trying to determine if a company has a durable competitive advantage. Question 1. Consistency. Look at the company's cash flow from operations, CFO, over the last 10 years. Has it been consistently and strongly positive? A company with a true moat doesn't have wild swings in its ability to generate cash. It should be a steady, upward trending line. Question 2. Source. Where is the cash coming from? Is the bulk of the company's positive cash flow coming from its core operations, CFO? Or is it coming from unsustainable sources, like selling off assets, CFI, or taking on debt, CFF? A moat business funds itself. Question 3. Margin. Calculate the company's cash flow margin, which is its CFO, divided by its total revenue. A high and stable cash flow margin is a powerful indicator of pricing power, a key component of a strong moat. It means that a large percentage of every dollar of sales converts directly into cash. Question 4. Conversion. How much of the company's reported net income is actually converted into free cash flow? This is the net income to free cash flow conversion rate. A business with a wide moat, like a software company or a branding powerhouse, often has a conversion rate well over 100%, meaning it generates even more cash than its reported profits. A capital-intensive, no-moat business might have a conversion rate of 25% or less. This four-step audit provides a quantitative, evidence-based way to assess the quality of a business and the durability of its competitive advantage, cutting through the subjective stories and focusing on the undeniable facts of cash generation. The path of the 99% is, once again, the polar opposite. This is the path of the growth-at-any-cost gambler. This type of investor is not interested in moats or consistency. They are addicted to narratives of disruption and world-changing technology. They invest in story stocks, companies that are often pre-revenue or massively unprofitable, but have a seductive story about how they are going to revolutionize an industry. Their focus is not on cash flow, but on vanity metrics, user growth, website clicks, revenue growth, even if that revenue costs more to generate than it brings in. They see a company that is burning through hundreds of millions of dollars a year as a sign of aggressive investment in growth, rather than what it is, an unsustainable business model. This was the mindset that dominated the dot-com bubble, and it has reappeared in various forms ever since, from clean energy to 3D printing to the more speculative software-as-a-service companies. The gambler buys the story, not the business. They are betting that the company will somehow, someday, figure out a way to become profitable before it runs out of other people's money. This is not investing. It is speculation of the highest order. They are ignoring the single most important question a business analyst can ask: does this business have a viable economic engine? The cash flow statement provides the clear answer to that question. A consistent, large, negative cash flow from operations is a clear signal that the engine is broken. The growth at any cost gambler ignores this signal at their own peril, and almost inevitably their portfolio suffers the consequences. They are participating in a financial lottery, not engaging in the serious business of wealth management. The direct financial connection of the moat principle is profound and impacts every aspect of a company's ability to create value for its shareholders. A wide moat business with strong, predictable cash flow is a financial fortress. It can fund all of its own growth opportunities from its internal cash flow. This is the highest quality, lowest cost source of capital available. It doesn't need to go to Wall Street cap in hand to ask for money. Because it generates more cash than it needs for growth, it can then reward shareholders directly. It can aggressively buy back its own shares. This is a crucial, often misunderstood point. When a company buys back its stock, it reduces the total number of shares outstanding. This means that your individual slice of the ownership pie gets bigger without you having to do anything. It's a tax-efficient way to increase your per-share value. A company with a moat can also afford to pay a generous and growing dividend, providing a direct cash return to you, the owner. A no-moat business, on the other hand, is trapped in a financial prison. It lives in a fiercely competitive environment, and any cash it generates must be immediately reinvested just to keep up with rivals. It has no excess cash to fund new growth, let alone reward shareholders. When it needs capital to survive or expand, it is at the mercy of the financial markets. It must dilute its existing owners by issuing new, often cheap, shares, making your slice of the pie smaller. Or it must take on high-interest debt, which cripples its future profitability and adds immense risk. Over the long run, the financial fortress will compound wealth for its owners at an extraordinary rate. The financial prison will, at best, stagnate, and at worst, destroy the capital invested in it. The moat, as evidenced by the cash flow statement, is the ultimate determinant of a company's financial destiny and, by extension, your own portfolio growth. We have now arrived at the final and most decisive pillar of our framework. It's not enough for a business to simply generate cash. The ultimate determinant of long-term value creation is what the company's management does with that cash. This is the fifth pillar, capital allocation, the final boss of cash flow. A brilliant business that generates billions in cash can see all of that value destroyed by a management team that makes foolish decisions with the money. Conversely, a good business can be transformed into a legendary investment by a CEO who is a genius at allocating capital. The cash flow statement tells us how much ammunition a company has. The study of its historical capital allocation decisions tells us how skillfully they shoot. Warren Buffett himself has said that the most important job of a CEO is capital allocation. And the person he has repeatedly called the greatest capital allocator of all time was a man named Tom Murphy, the longtime CEO of Capital Cities/ABC. The story of Capital Cities is a testament to the power of intelligent capital deployment. Murphy started with a single, floundering television station in Albany, New York. The station itself was a good business, a local media property that generated a steady stream of cash. But what Murphy did with that cash is what made him a legend. He and his partner, Dan Burke, ran their operations with extreme leanness and efficiency, maximizing the cash flow from their existing businesses. Then they would take that pile of cash and, with immense discipline and patience, wait for opportunities to buy other media properties, newspapers, radio stations, TV stations, but only when they were available at bargain prices. They were not empire builders. They did not chase flashy, expensive deals. They were rational, value-focused buyers of businesses. They would buy a new property, apply their lean operational management style to improve its cash flow, and then use that new, bigger stream of cash to go out and find the next deal. This was a rinse-and-repeat cycle of masterful capital allocation. They used the cash from their existing assets to buy new cash-generating assets. The culmination of this strategy came in 1985, when Capital Cities, a company that was still relatively unknown, stunned Wall Street by acquiring ABC, a company more than 3 times its size. They used their pristine balance sheet and the immense cash flow from their collection of properties to finance the deal. Over Murphy's 30 years as CEO, he delivered a staggering 20% annualized return to his shareholders, turning a $1 investment into more than $200. He did this not through some revolutionary product, but through the simple, relentless, and brilliant allocation of the cash his businesses generated. Buffett admired Murphy so much that he helped finance the ABC deal and considered it one of the easiest investment decisions he ever made. Because he wasn't just betting on the businesses, he was betting on the capital allocation genius of the jockey, Tom Murphy. The psychological bias that great capital allocators like Murphy and Buffett overcome is the powerful action bias. Most CEOs, and indeed most people, feel a deep-seated need to do something. When a company is sitting on a large pile of cash, the pressure from Wall Street and from within the company itself to use that cash is immense. This leads to what Buffett calls the institutional imperative, the tendency for corporate managers to imitate the behavior of their peers no matter how foolish. If other companies in the industry are making big acquisitions, the CEO feels pressure to make one too, even if it means wildly overpaying. This action bias often leads to value-destructive diversification acquisitions that serve the CEO's ego more than the shareholder's wallet. A great capital allocator has the rare ability to resist this bias. They possess the patience to sit on cash, sometimes for years, waiting for the perfect opportunity to arise. Charlie Munger has said, "The big money is not in the buying and selling but in the waiting." This intelligent inaction is often a far more powerful creator of value than frenetic, ill-conceived action. When there are no attractive investments to be made, the best capital allocators are content to let the cash pile up or to return it to shareholders via buybacks. They understand that their job is not to be busy, but to be rational. They deploy capital only when they can do so at a high rate of return. This ability to override the innate human bias for action is a hallmark of a truly superior executive and a key trait to look for when analyzing a potential investment. To evaluate a management team's skill in this area, we need a final mental model, the shareholder-friendly capital allocation test. This is a hierarchy of the best uses for a company's free cash flow, from the most value-creative to the least. When you analyze a company's historical cash flow statements and annual reports, you should be looking for evidence that management thinks in this rational way. Option 1, the highest and best use of cash, is to reinvest it back into the core business, but only if those reinvestment opportunities can generate a very high rate of return. A company that can spend $1 to build a new factory that will generate 20 cents of cash flow every year thereafter is a compounding machine. You can check this by comparing their capital expenditures against their return on invested capital, ROIC. Option 2, if high-return internal projects are not available, is to make smart, value-accretive acquisitions. This means buying other businesses at reasonable prices that either fit strategically or offer great financial returns. You must analyze the company's past acquisition history. Did they overpay? Did the acquisition actually add to per-share value? Option 3 is to pay down debt. Strengthening the balance sheet reduces risk and increases financial flexibility, which can be immensely valuable during an economic downturn. Option 4 is to buy back shares. This is a great option if and only if the company's stock is trading below its intrinsic value. Buying back overvalued stock is just as foolish as overpaying for an acquisition. Finally, option 5, the option of last resort when none of the above are attractive, is to return the cash directly to the owners by paying a dividend. A management team that thoughtfully moves through this hierarchy is demonstrating a commitment to shareholder value. One that squanders cash on dumb acquisitions while their stock is cheap is showing you that they are poor capital allocators. The antithesis of this disciplined approach is the investor who worships the empire builder CEO. This is the investor who gets excited by headlines, who loves to see the companies they own making big, flashy acquisitions and appearing on the cover of business magazines. They equate activity with progress. They don't do the hard work of analyzing the price paid for an acquisition or calculating whether it will actually generate a decent return on investment. They just like the story of a bold, aggressive CEO who is transforming the company. The most infamous example of this in corporate history is the disastrous merger of AOL and Time Warner in 2000. It was hailed at the time as a brilliant move that would define the future of media and the internet. Investors who worshiped the empire-building CEOs involved piled into the stock. But the deal was done at the absolute peak of the dot-com bubble, with AOL's wildly overvalued stock being used as the currency. The promised synergies never materialized, the cultures clashed, and the deal ended up destroying hundreds of billions of dollars in shareholder value, becoming a textbook case of value-destructive empire building. The investors who had rewarded the action, rather than demanding rational capital allocation, paid a brutal price. They failed the final test. They understood that a company was generating cash, but they didn't care enough about how that cash was being used. This brings us to the ultimate direct financial connection. Intelligent capital allocation is the multiplier effect on a business's cash flow. It is the engine that converts a stream of cash into a mountain of long-term wealth. Consider two companies that each generate $1 billion in free cash flow per year. The CEO of Company A is a master capital allocator. He reinvests that $1 billion into projects that earn a 20% return. He is creating $200 million in new value for his shareholders each year. The CEO of Company B is an empire builder. He takes his $1 billion and buys a mediocre competitor at a high price, a deal which only generates a 5% return. He has only created $50 million in value. Over a decade, this difference in capital allocation skill will result in a Grand Canyon-sized gap in the intrinsic value of the two companies, and consequently, in their stock price performance. The ability to identify management teams that are not just good at running their businesses, but are also brilliant at deploying the cash those businesses produce, is the highest level of business analysis. It's the final link in the chain that connects cash flow analysis to extraordinary, multi-generational portfolio growth. It is the final promise of learning to read the one number that truly matters. You have just invested a significant amount of your most valuable asset, your time, to rewire your financial brain. Take a moment to recognize the power of the tool you have just acquired. You have moved beyond the 99% of market participants who are staring at the shadows on the cave wall, the flickering, manipulated illusion of reported earnings. You now possess the financial X-ray vision to see through the surface-level accounting and perceive the hard, undeniable reality of the cash that flows through the bones of a business. You can now distinguish a true cash-generating machine from a capital-incinerating imposter. This skill alone, rigorously applied, will protect you from countless investment mistakes and guide you toward the kinds of high-quality businesses that are the bedrock of lasting wealth. It is a profound and permanent upgrade to your mental arsenal. But a weapon, no matter how powerful, is only one part of a complete arsenal. A foundation, no matter how solid, is only the beginning of a fortress. Understanding the cash-generating power of a business is the essential first step. It answers the question, what is this company's true economic engine? But this immediately raises the next, equally critical question, what is that engine worth? Knowing that a company is a phenomenal business is not enough. The history of investing is littered with people who correctly identified the best businesses in the world, but paid such a high price for them that their returns were mediocre or even negative. The art and science of value investing is not just about identifying quality, it is about buying that quality at a discount to its intrinsic value. The video that is now appearing on your screen is the missing link. It is the crucial next piece of this intellectual puzzle. It takes the owner earnings figure you now know how to calculate and bolts on the valuation framework required to determine a rational price to pay for that stream of cash. It connects the what, a great business, to the when, a great price. It bridges the gap between business analysis and investment decision-making. The majority of people will stop here. They will feel satisfied with their new knowledge and drift off to watch something else. But the true intelligent investor, the individual committed to the path of continuous learning and mastery, understands that this is a network of interconnected mental models. To master one is good, but to master the system is to achieve true financial freedom. The choice, as always, is yours. The 99% are content with pieces of the map. The 1% seek the entire blueprint. Your ascent to a higher level of financial thinking is not over. It has just begun. Complete your arsenal. The next piece of the map is waiting for you. Click and continue the journey.